Karl Schamotta joining us, chief market strategist at Corpay. Karl, what do you think the bank earnings so far? Nice to see you, by the way. What do you think the bank earnings tell us about the state of affairs here in Canada right now?
Yeah, it's kind of interesting because I think you have two things coming into play here. One is, that credit quality question. Clearly, banks are sort of bracing for a wave of I guess, increases in I guess, indebtedness or in stress among Canadian households. That is leading to those higher credit provisions. However, if you put that into context, right, like mortgage delinquencies remain below where they were back in 2019. They're below where they were, vastly below where they were back in the global financial crisis. We know that we have roughly half of all Canadian mortgages set to renew over the coming years. So that delinquency rate is likely to rise. But the bigger picture here is a more fundamental one, a more fundamental issue with the Canadian economy, right? If we look back over the last couple of decades, the reality was that Canadian banks were making a lot of money lending into the economy, creating new loans of consumer loans, mortgage loans, pushing that cash into the economy. We know that has already fallen off dramatically relative to where it was, even 12 months ago, and that it's very likely to remain constrained in the future because Canadian consumers are so indebted, because interest rates are higher, because the outlook for asset prices, particularly homes, is much more negative than it was. All of that is conspiring to essentially lower the outlook for Canadian earnings, Canadian bank earnings in particular, right? Canadian banks are in a position now where they're not looking at the kind of growth that they were looking at even a decade ago.
So what do you think the Bank of Canada makes of all of this?
I think the Bank of Canada is well on top of this. This is not a material concern for them. They're really achieving what they set out to do, which was to slow the Canadian economy, which was to sort of increase the amount of economic slack, and to sort of slow that endless aggregation of credit that had been happening in the economy. And so, what we do think at this point is that the Bank of Canada is looking at the fundamentals. They're looking at, the shift in labor markets, the disappearing economic slack, the inflation that is now relatively close to target, and that all is coming together to mean that they are very likely to cut either in June or July.
What would be the determining factor on going in June versus July?
Yeah, so this is tough. Really, it might be a coin toss, right? The fun part here is that there is no crisis. There's no situation right now in which, unemployment is rising all that drastically, that inflation is, sort of going drastically below target, that we're seeing a crash in real estate markets or in the economy overall. None of that's happening. So there is some latitude to choose between that June and July. Now, July comes with the next business outlook survey, so that might help to influence policymakers. But my gut says that the bank at this point, they know that policy is in restrictive territory. They do want to go a little bit earlier and get this out of the way so that they can begin setting out that path beyond that first cut in the autumn.
And what about the debt loads of Canadians right now? That's not something that we can measure and make a determination on, like an inflation reading or a GDP reading.
Right.
How closely does the Bank of Canada have to be thinking about that over the longer term?
I think they very much have to be thinking about it. As this chart shows, the reality here is that the debt service ratio for Canadian households is higher than it is in any other G7 country. We went into the pandemic in an extraordinarily indebted state. That has meant that the economy is far more sensitive to interest rate increases. It means that the Bank of Canada is dealing with different fundamentals than the Federal Reserve is, that the Canadian economy is, that much more vulnerable to an increase in borrowing costs. And so it does mean fundamentally that the Bank of Canada is very likely in the years ahead to set out on a different trajectory than that we see from the Federal Reserve, right? It means fundamentally that policy can be easier in Canada and achieve the same goals as in the US.
And what about what this all means for the Canadian dollar?
It means that we're looking at underperformance in the long run, right? Short run, we might see a bit of a boost here, particularly if the U.S. economy begins to slow a bit and the Fed sounds more dovish. But longer term, the reality here is that interest rate differentials are going to stay tilted against Canada, and that is going to, fundamentally keep the loonie from appreciating all that drastically. Put that together with the fact that, Canadian consumers are becoming more cautious, that business investment's not picking up, and that the commodity sector is not playing its historical role in driving, sort of that capex cycle. You put all that together, that sort of paints a bearish picture for where the loonie goes over the very long run. You would say a couple cents lower than where we are today. We did already overshoot where we thought we'd get this year. So, I think at the end of the day, a couple of cents lower over the next year and a half, that's very, very probable. But in the near term, there's going to be some turbulence. And the main reason is that right now, markets are overly optimistic on where the U.S. economy is going, and global growth differentials are actually beginning to narrow. So in other words, other economies are beginning to catch up with where the U.S. is. That's going to put some downward pressure on the dollar at some point.